Chat with Traders, episode 152, has backing from online broker and technology provider TradeStation. Now, folks, there's a good reason why TradeStation clean up when it comes to awards, because they know what traders need and they deliver. From decent rates to powerful technology and analytical tools to helpful support, TradeStation are one broker you should not overlook. Learn more at tradestation.com/traders.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey crew, what is going on? Your host, Aaron Fifield here. Coming up on this episode, what you're about to hear is a conversation I had with Kory Hoang. Kory is not a veteran trader. He's not someone who has been doing this 10, 20 years. He's someone who's been doing this for only a few years, but he's begun to make decent gains on his trading capital. Kory is also not a full-time trader. Well, let me be clear. At the time we recorded this a few weeks back, he wasn't. But I've since been told he's handed in his notice and has taken the leap. So the point being, for the average listener, there are quite possibly a few similarities between your situation and Kory's situation. So how does he trade? Kory is a retail systematic trader. He's running numerous algorithmic strategies which he's developed, all of which are fairly simple. These run on various ETFs, ETNs, and even some cryptocurrencies. During our chat, we cover quite a bit, but mostly his journey and how he's progressed to this point. There was a moment, I'm just going to throw this out there, there was a moment around midway where Kory did lose me a little bit. If you happen to get lost too, just stick with it because it will all click, and I then take a moment to summarize his point also. As Kory talks about a few strategy specifics, I'd like to just remind you that you are entirely responsible for your own trading decisions. Okay? Enjoy the episode, team. This is Kory Hoang. Where's a good place to start? I mean, it might be helpful if we just hear a little bit about kind of what you studied at university. Did you go to university?
Yeah, I went to the University of Washington. I took a business degree and I majored in finance and marketing.
Okay, and what did you do once you got your degree?
So while I was still in school to get my degree, I actually took an internship at Merrill Lynch Wealth Management in Everett, kind of by Seattle, and that's where I really got my foot in the door in the financial industry and the investment industry in particular. And that's where I learned a lot about, stock market, financial market, trading, and all of that. And it, became really fascinated to me ever since that day.
Okay. So what were you doing at Merrill Lynch while you were there?
I was just an intern for 3 months during the summer in their wealth management division. I was tasked mainly with basically shadowing other advisors there. And, one of the guys there, I remember him to this day, his name was Kelly. I remember I walked into that office one time and he was in this big glass office facing, this was on the 10th or 12th floor of a building, and he was overlooking the ocean from the port of Everett. And, I look in his office and there was, screens and charts and all these cool indicators and everything. And I knew from that day, I want to just be like that guy.
Nice. So that obviously sparked your interest in trading, that whole experience. Was your internship there, did you find that to be any help once you started to get into trading yourself?
It did help me get kick-started in terms of, finding out what to research, what kind of stocks to look at, what for example, stock sectors, market sectors are, and things like diversification and, a lot of, basic beginner stuff for investing in general. So that did help me get started in the right direction. And from then on, it was just basically self-research and, looking up information online, reading books, and figuring out the rest from there on my own.
Okay. So just to put this in perspective, when did you actually start to get interested in trading or actually start trading? So I presume it was a few years back, right?
Yeah, so my internship at Merrill Lynch was actually 3 years ago, and that was the same time that I actually started trading. I was still in college at that time. I had a little spare money, just a couple grand. I started to trade, technology stocks, high growth stocks. I remember this one time I bet money on KNDI, Candy Technologies. It was a Chinese clean energy vehicle company. But long story short, I made some good money on it initially, made a couple grand off of it. But then, that company, it just didn't do really well. And then the stock kept tanking. I just kept trading it and didn't go well at all. And so I started losing money and had to take a break after a while.
So what were you basing your decisions to buy and sell on back then? Like, was there any methodology to what you're doing, or did you just have like a good feeling the stock was going to give you a nice return?
Yeah, to be honest, back then it was really just gambling. To be honest, it's just basically seeing what's moving today. What's the top market movers and what are the major themes in the market today. One of the things I was researching back in school was clean energy and electric vehicles, and so I thought I'd venture into that space and bet on a couple of stocks from that sector. So there wasn't really any methodology. Really, I mean, I did look at charts a lot, but I never really found them to be extremely effective.
Okay, so why did you feel as though it was gambling? I know you said that you felt like you were probably lacking a bit of methodology, but was that the only reason, or were you betting too big? I know you said you made some profits in one, was it Candy or something like that, and then it went right back against you and just kept holding. I mean, what were some of the reasons why it felt like gambling in the beginning?
Well, it felt like gambling because I did not follow a system. I mean, I would think that I have a system, but I would not follow it rigidly. And it wasn't a scientific process. A scientific process means that you come up with an observation and then you create a hypothesis, and then you go out and you do your experiment, you collect your evidence, and from then you analyze the result and make a decision. Is your hypothesis supported by evidence or not? That wasn't exactly what I was doing. What I was doing is akin to what a lot of traders that I see, when they just start out in trading or investing. They just have some sort of idea, some sort of intuition, or maybe they heard someone say, oh, this is a good stock, or maybe they read somewhere that, maybe they should buy a stock when the RSI goes to oversold. And they would just have some sort of idea of how to trade, and they would, think it'll make sense, and they would go with it without really testing that idea, maybe perhaps through a back test or forward testing with paper trading or something like that. They just go right at it. It's just like gambling.
Okay. And I just want to ask you, before we go too much further, what were your expectations like when you started out trading? Like, did you feel as though this could be an easy ride and an easy way to make money?
Initially I thought I could really day trade and make just 1% a day, and I'll be good for the rest of my life. And it was just really, naive beginners thought process that I'm sure a lot of people went through when they first started trading. But yeah, expectations were high, and sure enough, it was soon crushed by the reality of trading in the market.
Now, what caused you to start getting interested in algorithmic trading? I feel as though you maybe touched on it before when you started to talk about having more of a scientific approach to the types of strategies you trade. But, you started out as a discretionary trader. You started out just trading stocks and sectors that you knew a little bit about. What caused you to start gravitating towards algorithmic trading?
It was in 2015, and there was a TED Talk with Jim Simons from Renaissance Technologies. And I was very intrigued by that TED Talk because here we have, someone who's a mathematical genius. He's, had a great career in academics. And not only that, he used his knowledge from there and went into the financial industry, started a hedge fund, and managed to crank out, the best returns that anyone ever seen in the market. So And he did it all by using algorithms and following rules-based processes. So to me, that was what I needed to do, because I saw that as, a scientific process that he was doing. And to me, he was a scientist, and he was tackling trading and investing in a very scientific approach. And I figured, if I started imitating that process myself, I would hopefully be able to achieve the same sort of results.
Yeah, I have seen that talk actually. It's a really good one, and I'll dig up a link to that and put it in the show notes if anyone wants to also watch that. Was that the first time you'd heard of Jim Simons?
Yes, that was the first time I heard Jim Simons.
Okay.
It wasn't the last time. He came up in the news, many times after that, how about how his medallion fund is like the best performing hedge fund of all time. It's just insane the kind of returns that he cranks out.
Yeah, there's a really interesting article on Bloomberg about the medallion fund. I presume you've probably read that. It came out probably it was a few months ago, earlier in the year. So you've watched this talk. You've realized that you kind of like the approach that Jim Simons has taken, very algorithmic, rules-based, as you described. What did you do from there? Like, what resources were helpful for you to begin learning about algorithmic trading?
I would say the most useful tool that I ever came across was Quantopian. For some people who don't know what Quantopian is, it is an algorithmic trading platform that is open source. Actually, it's not a trading platform anymore. They disabled live trading recently, but you can still do a lot of research on this platform. It is based on Python, and you can code your own algorithmic trading strategy there. And they have a forum where a lot of quants and a lot of people who pursue that subject pose a bunch of algorithm and things that they come up with, and we would share idea and collaborate together on strategies. So it was a great place to learn. And I started out learning just like everyone else who doesn't know how to code. You just kind of like copy and paste and put things together, and just kind of like making a Frankenstein algorithm and run a back test on it and see if it would work. And you do that day after day, weeks after weeks, and months after months. You start to get better and better at it. And at the same time, Quantopian offer a course. They had lectures on how to build Python-based trading algorithm, and it's literally like a full university course on quant trading. That's my impression on it. I know to some people it might not be very advanced, but to someone who did not really have that kind of exposure, it was a lot of help, and it kickstarted my journey into algorithmic trading a lot.
Yeah, their lecture series is very top notch. I mean, I would consider certainly some of the topics there to be quite advanced. Yeah, and I love that feature about Quantopian, how you can like just clone other people's algorithms and then play around with them, tweak them, change a few things, and see if you can improve on it. And yeah, they also have a really good forum as well. I mean, I'm not really much of a fan of forums generally, but Quantopian have a really quality forum. Like you can find some interesting insights there. So did you know how to code in Python prior to this? Because as we know, Quantopian's platform only takes Python as the input language. I mean, had you had any experience coding in this language before?
Absolutely not. Before I discovered Quantopian, I did not code at all. I mean, the closest that to coding was using Excel spreadsheet. And back in college, most of my courses were mainly business and finance courses. None of it was for programming. So if I could go back to school, that was probably one of the things I would change, to take some programming classes.
Absolutely. I mean, that's one thing I wish I would have picked up a lot sooner, is learning how to code.
Hey, we all. But yeah, so with absolutely no coding experience, I just kind of dive head in. And, it took weeks and weeks before I finally figured out how to get basic features running, like running a full back test and factoring in commission and slippage and how to change stock symbols and all that stuff. It did take a while, the learning curve was, a little bit steep at first, but, this was something I was really passionate in and that I really enjoy doing. So to me, it wasn't really, something that was strenuous. It was something that, I was looking forward to doing. I remember staying to, 2 or 3 a.m. just coding algorithms and learning how to use the platform.
Yeah, it can be kind of addictive in some ways, right?
Yeah, certainly. Because, once you understand the capability that this tool can offer you, and all it takes is for you to learn it and get better at it, you just kind of get into that mindset and just push yourself to do it.
Yeah, totally, man. Now, were you using Quantopian to actually learn Python as well? Or were you like doing some other online courses and classes, etc., from other places on the net?
I did take the course from Udemy, but I never really finished up with it. So my experience with Python so far is, I'm not like the typical programmer who knows Python and can code like an app or some sort of interface for you. So I'm not that kind of guy. I strictly know how to use Python on the Quantopian platform only. And my break really came when I discovered TradeStation, because TradeStation uses a much simpler coding language called Easy Language. And TradeStation has like charting platforms and interfaces that, I was much more accustomed to. Quantopian, it was very much text-based and code-based and very little charts. And you can code them yourself, but for me to do that at that point, it was a huge learning curve. So when I found TradeStation and I discovered, the ease of coding in Easy Language, I started playing around with that platform a lot more, and I started migrating my trading over to TradeStation.
Okay, and I presume at points throughout this whole process, there's been points where you've kind of got stuck or hit a wall and got maybe frustrated because you can't work something out. What do you do in those sorts of scenarios?
Well, what I usually do when I'm stuck at something is I find someone else who can help me figure it out, someone who actually knows how to code. At first, it was a bit difficult because usually the people who knows finance don't know how to code, and usually the people who know how to code don't know finance. So to find someone who has some sort of quality of both was very difficult. I remember trying to work with programmers who have no financial knowledge, and it was okay. And I tried to teach them, what I did know, and what I wanted my strategy to be, and try to guide them through the process. But it was very difficult. It's basically another learning curve for them that they have to tackle on. And for the amount of money that I was paying them, they obviously were not interested in pursuing that route. So, but eventually when you have a forum like Quantopian, you can find collaborators fairly easily. And, when I start using the forum there to reach out to people, to coders to help me with my strategy, that's when I really found, that's when one of my first breakthrough really came, when I found someone to help me implement one of my strategy that I had in my head. It was just a concept, and he helped me lay it out in Python, and I was able to observe like how the Python code was structured, and I basically reverse engineer and learn it back from there.
Okay. Yeah. I mean, that's certainly a smart way to go about it. And the forum, a lot of people are really helpful there. So, if you have questions, it's a good place to find some answers. How long did it actually take you to go from doing back tests and different forms of analysis to actually starting to run some real money through your strategies?
So I began coding strategy and, trying to back testing since I think the start of 2016. And from then it took me about 6-7 months to finally get comfortable enough to throw some money at the algorithm that I have coded. And, it wouldn't be a lot of money. It would just be like $5,000 or $10,000. And I wouldn't even trade the whole amount. I would just make the algorithm take very small portion of that money. But, it was enough to test out my idea, to do some walk forward testing. And from then on, it helped me build more confidence because, I can see that my money is being put to work by this machine that I built myself. And knowing how this machine works and seeing it in action after, weeks and weeks and weeks, it built up your confidence to the point where you realize that, this is real. Like I always read about this, I always heard about this, and, now I'm actually experiencing it. So.
Right. Do you remember your first automated trade?
To be honest, I can't remember the first one, but I remember my first biggest win from automated trading. It was in the summer of 2016. I forgot what happened, but that week my algorithm bought XIV, an inverse volatility ETN. It bought it, at a really good time, and it sold it, about a week later, and it made some good money on that. And from that onward, I was hooked.
Yeah. No, it's a good feeling, man. So when did you feel confident to actually go live with this first strategy? Because, I presume of course it wasn't the first strategy you'd tried. You'd tried to, without trading real money, right? So like you'd back tested different ideas and tried different things, but this particular strategy which you decided to go live with, you obviously felt confident in that. Like, what gave you the confidence to go live with that particular strategy?
Let's see. When I first created a profitable algorithm, I knew it was profitable because it was a very simple algorithm. It's literally a moving average crossover, but the asset and the time frame that I was using it for, it just worked out perfectly. And so just because I understand how it works and the simplicity behind it, it gave me a lot of confidence to start going forward.
Okay. And I know some people, I think, probably freak out about the idea that a computer is trading their money for them, right? Was that an issue for you? Like, did you struggle with that aspect of it, just taking your hands off and letting the computer take over?
To be honest, I think I had it easier than a lot of people, because when I started building my strategy and creating my algorithm, that was when I started researching into, market anomalies and taking, really quantitative approach and research into, how to figure out what assets and how to trade them. And, I think it was luck, perhaps, but the framework that I developed, it ended up working out really well. And I'm still using it to this very day. And, all the algorithms that I built and create are from this framework that I use. And it is rather simple if I really break it down to you. Due to the simplicity, it is very robust. And, it's been more than 1.5 years of walk forward testing and live trading now. So it's given me a lot of confidence to keep moving forward with this system.
This episode of Chat with Traders is brought to you by TradeStation. When you become a TradeStation client, you're putting yourself in a position to better analyze and trade markets, especially as a retail trader. As traders, we have enough challenges as it is, so roll with an online broker who understands what traders need. TradeStation equip their clients with awesome commission rates and professional grade analysis tools which you won't find being offered by other brokers. Just as an example, TradeStation allow you to create your own custom indicators and your own custom strategies, then backtest these ideas on large amounts of historical data and even automate them if that's what you're into. Take this hot tip. Discover what it's like to trade with TradeStation by visiting tradestation.com/traders and open an account. Also supporting this podcast, once again, is Health IQ. Health IQ believe that the best way to improve the health of the world is to celebrate the health conscious through social and financial rewards. By using science and data, Health IQ secure lower rates on life insurance for healthy folks like runners, cyclists, gym junkies, vegans, etc. Here's a fun fact which should grab your attention. 56% of Health IQ customers save between 4 to 33% on their life insurance. These savings are exclusive to Health IQ. Just like how you save money for being a good driver, Health IQ are here to get you lower rates on life insurance for living a health-conscious lifestyle. To see if you qualify, get your free quote today at healthiq.com/chat. That's healthiq.com/chat to get your free quote. So how many systems or strategies, whatever you want to call them, are you running nowadays, like at the moment?
The way that I do things is I have two different type of algorithms that I run. The first one is my binocular. So this is an algorithm that I developed based on my observation and research into market anomalies. I call it my price anomaly detection algorithm. So what this algorithm would do is it would scan all available securities in the market, and based on a proprietary metric that I developed, it would classify which asset at which time interval exhibit price anomaly, meaning if it has mean reversion properties or if it has momentum or trend persistence properties. And of course, this system would also tell me, this algorithm would also help me identify assets that are random walk. And according to my framework, I don't trade random walk assets. My algorithm indicates to me that about 95% of the available assets and time intervals out there are random walk, and it is not profitable for for most people to come in and trade those assets because they don't have any edge because they're random. You can't trade something that's random. But about 5% of stuff out there, they do exhibit certain trends and anomalies that show up time over time, and it's those assets that you want to focus your trading on. And this is when I start using my second set of algorithm. So the first one was the binocular, the price anomaly detection algorithm. The second set of algorithm, I call them my rifles. So this is when, after I have identified my prey, like a hunter, I would take my rifle, some very simple rifles at times, and I would go in, I would hunt down my prey. to put it in a simple to understand way.
Okay. Now, I just want to go into a few of those things you said there. Okay, so I guess the first one being framework. You've used this word a few times. I just want to make sure that we're clear on what you're actually referencing when you talk about a framework. So what are you referencing?
Okay. All my research so far, ever since I started investing, trading 3.5 years ago, indicates to me that the market is mostly efficient. If you study, French and Farmer modern portfolio theory, they say that asset prices are efficient because the market discount all available information into prices almost instantly. So, the best thing you should do out there is really just buy and hold an index fund and just let it ride. So my internship at Merrill Lynch kind of had me subscribe to that idea for a while, until one day I realized that, perhaps that's not the whole truth out there. Perhaps there are certain pockets in the market where inefficiency still exists. And so, it was at that point that I realized that efficient assets are random, because when they are efficient, there are no extractable alpha, or there's no edge in trading them. Therefore, that's why they are efficient and they are random. You can't predict these things. However, certain assets out there are inefficient, meaning there are repeatable patterns that keep showing up and people are not exploiting them. If that pattern, or what I call anomaly, is large enough for you to exploit yourself, then you should definitely do it. So that's basically what my framework is about. I use the price anomaly detection algorithm to scan all available asset, my binocular to find my prey. The ones that are random and, that can't be hunted down, I disregard them and I don't trade them. But the ones that do show a high level of anomaly that, is exploitable, then I would come in and trade those assets with my more optimized algorithm.
Okay, so in some ways, this binocular algorithm, I guess you could call it, that doesn't actually take any trades. It's purely just a scanning tool, essentially.
Essentially, yes. So what this algorithm does is it uses an oscillator, a technical oscillator, to measure the expectancy of momentum or mean reversion for any particular asset at a certain time interval. For example, I can use this algorithm to scan all ETFs on a daily interval. And at the end of the scan, it would produce me a market map. This market map, it looks like an X and Y plot. The X-axis would be for momentum expectancy, and the Y-axis would be for mean reversion expectancy. So in the middle of the plot, where the two axes intersect, is 0. So in the bottom left quadrant, it's the random walk zone. That's where 95% of assets tend to end up because they're random and unpredictable. However, in the top left quadrant and the bottom right quadrant, those are the quadrant where you would find momentum and mean reversion anomalies, where assets would exhibit certain trends that are persistent throughout time. And assets that fall into those zones, I would assess them and find the one that offer me the highest risk reward ratio. And then I would go in and trade just those asset only, maybe 4 or 5 of them. And these usually tend to be ETFs. So, it's been pretty good for me following the system that I developed.
Now, the price anomalies that you're talking about, can you give us just maybe an example of one anomaly which you might use?
Certainly. So when I'm talking about anomaly, I'm actually just talking about 2, and it's momentum and mean reversion. Matter of fact, how I got started thinking in this direction is when I went to QuantCon, hosted by Quantopian in 2016. I think it was April in New York. So I flew out to New York and I met up with some people there, and we went and we saw a couple of lectures and talks by some of the best people in the industry, some of the brightest quant out there. And there was a person who came all the way from India. His name was Manish Jalan of, I think, SG Analytics. Yeah. And he came all the way from India just to give a talk at QuantCon. And so, I figure I'll go to his talk and see what he has to say. And it was at that talk that he opened my eye to price anomalies. It wasn't really, fully 100% clear to me at that point. But, after I went home and take into consideration what he talked about during his lecture there, I finally understood what he meant. And from then on, I developed the rest of my framework from there. So when I was in that talk, he showed me one of the topics that he touched on was, figuring out how to trade certain assets in certain style. Like you can't use the same trading style for every single asset. And so he put up on the projector a picture of an RSI oscillator. And so I look at the RSI, everyone's familiar with the RSI indicator. And so I look at the RSI and he said, if I was to buy when the RSI is oversold and sell when the RSI is overbought, what technique did I just use? And, for a while, everyone was like stumped. And then he said, that is a mean reversion technique. And I thought about it. I was like, you know what? That makes sense. If you buy it when it's oversold and you wait for it to bounce back, and then sell it when it's overbought, you're waiting for it to mean revert. And then he also said, what do you think a momentum technique would be? At first, I couldn't figure it out, but then it was very simple. He said a momentum technique would be to buy when it's overbought and sell when it's oversold. The exact mathematical opposite of mean reversion. And so from my experience from that lecture there, I went home and I thought about it, and I realized that, he is right. And I started doing some more research and trying to come up with my own evidence to support, what he had to say. And in the course of looking for these evidence, I stumbled upon these anomalies that is momentum and mean reversion in the market. Certain assets, you can use momentum technique on them and it would work really well. But what that means is if you use mean reversion techniques on these assets, you're going to do very poorly. And so for certain assets, neither mean reversion or momentum technique would work well on them. And those assets tend to be random walk because, they don't show a persistent trend, neither a momentum or mean reversion trend for you to follow. So that is basically what my entire framework is based on, identifying which assets shows momentum properties and which asset shows mean reversion properties. Identify the ones that exhibit the highest level of those anomalies and trade those assets only. Meanwhile, avoid trading all the random walk assets.
Okay, now I don't want to confuse things here, but the example you gave about the RSI between what might be a mean reverting characteristic and what might be a momentum property or characteristic. You said if the RSI is pointing to overbought and you sell that, that's a mean reversion type of trade. If you can look at it the opposite way and it's a momentum type of trade. So how does that work? Because wouldn't that give you a signal to also go long as well as go short the same stock?
So this is the part where you have to identify which asset exhibit momentum anomalies and which asset exhibit mean reversion anomaly. For example, I've done this myself, so I know SPY on a daily interval exhibit mean reversion property. Right now it does. Back in the 1960, it did not exhibit mean reversion properties. In the 1960, if you bought the S&P the day after it has gone up, after it has gone positive, and you hold it and sell it the day that it finally starts going down, had you followed that basic momentum system, you would have made, I can't remember the number, but you would definitely have outperformed the market many, many times. But sometimes around the 1980s and 1990s, that system stopped working. However, the reversal of it started to work, and that was mean reversion. So whenever the market started, the S&P started going down, the data started going down, you buy it, and then you sell it the first day it started going up, that system would have started making you money. So because I did this research myself, and I saw it in the S&P 500, I figured this anomaly must also exist in other assets. And so I went out, I scanned every single one of them, and sure enough, I was able to identify certain ones that have very strong momentum anomaly. A couple of them are inverse volatility products, like XIV, SVXY, junior gold miners, ETF like GDXJ exhibit very high momentum anomaly on the intraday interval. Also, junk bonds. This was kind of surprising, but on the 2-hour interval, junk bonds, HYG, the ETF, exhibits momentum anomalies. So if you use a simple RSI system where you would buy it when it is overbought and sell it when it is oversold, you would make decent money over time trading those assets.
Now, are you scanning these different symbols every day, or is this just what you've done in your initial research and then you've traded mean reversion on those particular names?
Yeah. Right now, I'm working on a system where it will be constantly monitoring it. But for now, I'm just taking a snapshot every quarter. So at the start of each quarter, I'll run the scan, and I'll run it on many time interval. For example, run the scan on all ETFs on a 30-minute interval, and then an hour, and then 2 hour, and then daily interval, and then perhaps weekly interval, monthly, quarterly at the most. And so after I run the scan, at each time interval, I will get a bunch of results. And so I would get the XY plot for every single time interval. And on these XY plots, on each time interval, it would indicate to me which asset is currently exhibiting momentum or mean reversion anomaly. Once I figure out, out of all of those, which one gives me the best odds, then I go after them.
Okay. I think this is all starting to make sense and come together. So just to summarize what we've been talking about here, every quarter you run this scan through your binocular algorithm, right? And it determines which symbols, which stocks or ETFs or whatever it is you're trading has strong characteristics of mean reversion or strong characteristics of momentum. And then you take kind of the strongest out of the strong, and then that's what you trade your other strategies on. So if it shows strong properties of momentum, you're going to trade those names with momentum strategies. Is that correct?
Yes. A lot of traders, they tend to think that, the secret lies in the strategy, in the perfect indicators, in the perfect rules, the perfect money management system. I mean, all that play a part in becoming, in creating a successful strategy. But from my experience, that's not where the secret lies. It's not in the system that you traded. It lies in the asset. If the asset is random, there is no way you can ever try to make it work for you. I mean, personally, I have not found a way yet. I shouldn't say never, but personally, I haven't found a way to trade random assets. But when you can find certain assets that exhibit certain patterns that keep repeating over time, you need to be, you got to be a really big chicken to not go out and take your chance at that, because it keeps showing up over and over and over again.
Okay. Yeah, no, this makes sense. I'm following with you. I was a little bit lost for a moment there, but yeah, no, it's very clear to me now. I might just say, if anyone has any questions around this, would you be open to answering those in the comments section of this episode on the website?
Yeah, so I wouldn't necessarily share all my secrets, but from my experience with Quantopian, other people have been very willing to help me and help me get started to where I am today. So, I'm just trying to return the favor and doing the same. So, obviously, I have a day job, and I'm trading. My algorithm trades on the side, so I don't have a lot of time to cater to everyone. But I try to answer as many emails as I can, if that makes any sense.
Of course, yeah. No, we obviously be respectful of your time, but I'm just thinking if this part wasn't clear to someone, I don't expect you, and I don't think anyone expects you to give away the secret sauce. Yeah, just if they need a little bit of clarification around your framework there. But anyway, let's keep moving. So let me ask you this. How do you come up with strategy ideas? Okay, so once you've classified different assets into either having mean reverting characteristics or momentum characteristics, how do you actually come up with the idea for how to trade those assets?
This is a little bit interesting because I draw from my own personal life experience to come up with these strategies. So just a little bit background about myself. I was born and raised in Vietnam. I actually wasn't from the United States. I came here in 2004 with my family when I was 12. So for a good part of my life, I was growing up under communism, under a system that was a hybrid between communism and capitalism, to put it that way. And when I was in Vietnam, I had the chance to learn a lot about the Vietnam War. That was actually one of the major topics that you had to learn about in school. And I had to learn about the tactics that were used during the war. I don't know why they were teaching kids those kind of things back then, but they did it anyway. So you learn a lot about guerrilla tactics and what the Viet Cong, the Vietnamese communists, used to against the Americans during the war. And some of that theme, it kind of stuck with me for the rest of my life throughout everything that I kind of do. Guerrilla tactics, if that makes any sense. So, for example, one of the things that a guerrilla would do during that war is they never openly confront the enemy who is superior to them in open battle, right? So that's kind of like me. And the way that I'm trading, when I create strategy, I don't create a strategy to trade every single thing out there because I know that I don't have the capability or the skills to do that. I want to focus my trading on, things that I know that I'm really good at. Just like guerrilla tactics, you don't go out and you fight everywhere. You focus on the most vulnerable target and on the most, the one that will do the most damage and for the best bang for the buck. I keep my strategies very simple. Just like, when during that war, we had two sides. One was like technologically 100 times superior, and the other side was, fighting in jungles and using bamboo trap. But, we all know how that war ended up, and simplicity at the end of the day won that war, among a variety of other reasons. So that's why I keep my strategy very simple. I try not to overcomplicate it. A lot of my strategies are built with just a couple of variables, just a couple of inputs, maybe 2, 3, less than 40, 50 line of codes at best. It's working out really well, surprisingly. Something so simple and, not very complicated could deliver such robust result over time.
Now, most of these strategy ideas revolve around indicators.
Most of what I use is technical indicators, and I don't use it like a lot of what people call technical analysts. Technical analysts tend to look at a chart and draw some sort of trend line or see some sort of patterns emerging, or maybe they'll look at technical oscillator and like the RSI, and they would come up with some sort of subjective idea about it. Now, I don't want to say that that doesn't work or it won't ever work, but in my experience, when you follow that route, there's a lot of subjectivity and a lot less science in it. It becomes more an art than a science. So when I use technical indicators, I obviously don't draw trend lines. I don't, see random patterns like, bullish flag or whatever in my chart. I use technical indicators as basically triggers to initiate my trades and I use them in very quantitative manners. So for example, if I use the RSI, I would only buy when the RSI hit a certain level and only sell when it hit a certain level. And that would be defined, and I would follow that without fail every single time.
Okay. And what's the maximum number of parameters you'd feel comfortable including in a strategy? Let's say a number of parameters or conditions which must be true for you to enter into a position. Like, I know you like to keep things very simple, so just so we really get a grasp on that.
Usually when I create strategies, because I don't put too many inputs in there and, overfit the strategy or data mine sometimes, it tends to have very few inputs. Maybe I would say less than 10 inputs. Most of the time, probably won't even get above 5 or 6. Things, those input would be something like the length of the RSI or the length of the moving average, and whether or not I want to short sell or not, or what is the percent allocation per trade, and what the stop loss and profit targets are. Done. Nothing too fancy, nothing too complicated. It depends on how strong the anomaly is. So, for example, and you can go out, you can verify this yourself. On a daily interval, if you look at SPY, and if you were to use an RSI, a 2-period RSI, and if you were to buy when that RSI is below 30 and sell when it's above 70, that system produced very good result over the past 10, 15 years. I don't recall exactly what the numbers was, but the Sharpe ratio was very high. It was above 1 compared to just buying and holding SPY itself. As a matter of fact, that system during 2008 managed to avoid a lot of the drawdown that SPY experienced.
Okay, and when you say buy when these conditions are true, how do you exit that position? Like, what's the guideline there?
On certain system, I would have a profit target, but most of my system, the exit condition would be based on my indicator. So, for example, if the RSI is oversold, I would buy, and when it's overbought, then I would sell. And I would not use any sort of stop loss or profit target, because that system I just described there is a mean reversion system. You tend to want to let mean reversion system have some room to jiggle before it mean revert back up. So using stop loss can sometimes cut you out of trade too early. And a lot of time when you put in a profit target, you don't capture the entire move of the trades and you would exit early. So in my experience, using profit target and stop loss would only be reserved for assets and time intervals that offer lower intensity in momentum or mean reversion.
Okay. And I realized you'd already explained how to exit that particular strategy before I asked you. Exit when the RSI crosses 70. So, okay. So where are we here? Now, as you've been live trading a few strategies now for, how long has it been? It's probably been about 18 months since you first started live trading with algos.
Let's see. I think I've turned my first algorithm on July of 2016. So 12 months.
And a bit. Okay.
Yeah. About 15 months. Yeah.
Yeah. Have there been any times when you've stepped in and overridden your strategies?
A couple of times. And I've learned that I should stop doing that because, the time that, I missed out the most was after the election of 2016. After that election and when the market was still going up, initially I thought it was kind of weird because my expectation was, the market would not react well to a Trump presidency for various reasons. So I decided to go against what I typically do, which is to trust my algorithm to do the trading for me, because I already identified the anomaly, I already designed the system, I already tested it, and it's working. I should stick to it. But for some reason, after that election, I had a little of doubt, so I decided to turn my system off for a couple of months, and I did not turn them back on until March of 2017, and that was a really big mistake, because had I had it on during that time, I would have made, close to 30-40% during that period. So lesson learned. Lesson learned.
So what sort of returns are you aiming for? Like, what would you classify as a good year for you?
So according to the backtest that I'm running on my strategies, I'm running 7 different algorithms right now. And when you put them all together in a portfolio, each one of them is taking 15% of my account per trade. So my account is not leveraged. I don't use leverage at all. I do short sell, but not on a lot of asset. Matter of fact, I only short sell on junior gold miner ETF. And these systems, when you put them all in conjunction, working side by side with each other, the back test is telling me I can expect around 60 to 70% in annual return. Now, I know that sounds really wild, but again, I am trading inverse volatility securities, and these securities have been shown to deliver incredible returns on certain years, but also during other years they could produce very incredible, disastrous results, which is part of the reason why I use algorithm to trade them and don't trust myself to do the manual trading.
Yeah, I mean, I don't think that sounds absurd. You know what I mean? Like, you're not trading $10 million. So, to aim for 60, 70% a year, I think I don't see an issue with it. Now, how do you monitor your strategies in real time? Like, is there anything you do on a day-to-day basis to just check that everything's running smoothly as it should be?
Yeah. So, I work a day job, and I don't have the luxury of monitoring my strategies all the time, but I host it at my home computer, and I remotely connect into my home computer every now and then to check up on my algorithm and see how they're doing, see if all the trades are executed or if the API is still connected. One of the big lesson I learned this year during the summer was I took a vacation. I took about 2 weeks off to go to Southeast Asia, to go back to Vietnam and travel. And during that time, I still had my algorithm on. And they were running just fine until it was a couple days before my trip was over that the API went offline for some reason. And so for a while, the algorithmic trading platform that I was using, which is called Multi-Charts, was not connected to my broker. And because I was overseas and did not have regular, internet connection, I was not aware of that. And so by the time I found out, I was already down, I think about 5% or so in max drawdown, which, wasn't a lot, but, it was a stupid mistake that could have been prevented had I, decided to check on it more often. So definitely learned a lesson there to, even if your algorithm are automated and your strategies are doing the trading by themselves, you still should check in every once in a while to, or perhaps daily if you can, to make sure that everything is running smoothly, because, things can always go wrong. You can't bank on the fact that your strategy will keep on working perfectly 100% of the time.
Another lesson learned. Now, how has it been for you to hold down a full-time job and do this, I guess, part-time, like you do this after hours? Has that presented any challenges for you, or do you find it's a good lifestyle?
It's been pretty good for me. I mean, my algorithms in total, since I started them in March, they're up close to 17% this year so far. I know that's nowhere near the 60 or 70% mark that I'm aiming for, but there's been a couple of times this year where I turned them off or did not, let them run 100% of the time. So, but the risk-adjusted return is very good. My Sharpe ratio right now is about 2.0. So, and having that running just on the side while I'm working, I find it to be incredibly easy. Maybe it's just because I'm not handling a lot of money right now, and it's just my own personal money. And perhaps that's why it seems easy not to worry about, your money being traded by a bunch of robots in the market. But, I go to my day job, I take care of my duties. Perhaps I glance over to my algorithm at home via remote connect every 2 or 3 hours or so, make sure that everything's running fine, and get right back to work. And at the end of the day, I go home and tally up, how the algorithms perform today. And, if I made money, if I lost money. Most of the time I go home and it's all green. Some days I go home and it's red. But I've seen that so many times now that I'm not even fazed by it anymore. I'm just like, oh, okay, cool. And then, do whatever else that I want to do, and keep the algorithm running for the next day and repeat.
Yeah. And are you working towards going full-time into trading, or are you just happy to keep doing things as they are for the time being?
I do, in several different paths. One of my plans is to eventually start a hedge fund and implement these strategies that I've developed for the hedge fund. But in order to do that, I need to start building track record first. So that's one of the first things that I'm focusing on doing right now.
And tell us a little bit about, there's something very interesting about you, and that's the fact that you're donating a portion of your profits to charity. So do you just want to tell us a little bit about what you're doing there?
Yeah, so I have a startup. It's called Quant Profit. This is one of my startup projects. So the website is www.quantprofit.com. And what we do is we are a financial tech startup here in Seattle, and we are developing a platform where we will be hosting algorithmic and quantitative investment strategies that we collect online from various sources like Quantopian and blogs and podcasts even and books. And we would sort of just collect all these strategies from online, and we would go through them, make sure we pick the quality ones, we remodel them, test them ourselves, and then once we have a good library, we put it on our platform and we make it available for people to subscribe to. So if they see, for example, a gold trading strategy on my platform that they like, they can look it up, see all the statistics, all of the trade signals that is taken in the past. And if they want to, they can subscribe to that strategy, and they would receive trading signal notification from it. So as part of this startup, we are also running a charity program we call it Trading for Charity. So what we're doing right now is we seeded the program with $30,000 in March, and we hook it up to my trading algorithm system that I've been using. And at the beginning of the year, in March, we said that by the end of the year, we will take half of our profit generated by the algorithm, and we would donate it to Step Up for Laos, which is a nonprofit organization here in Washington State. One of my friends, he worked with UW, a University of Washington professor. I can't recall his name right now, but he has a nonprofit organization here in Washington State called Step Up for Laos. And he, for $75, he creates a prosthetic limb, and he sends it over to Laos, where it is given to children victim of UXO, unexploded ordnance, which is a remnants of the Southeast Asian conflict 30, 40 years ago. There are actually a lot of children victim in Laos who step on landmines and get their limbs and legs just torn off, and it's a really sad situation over there. So I'm personally from that region of the world, and I kind of saw that that scene myself before in life, and I decided if I'm going to start a business or start a project, I might as well add some corporate social responsibility aspect to it and try to make a difference. And at the end of the day, if you're a trader, you can't never have too much good karma. So hopefully by doing this, hopefully I will inspire other people to take the same approach, take some of their blessings and winnings from the market and give it to the less fortunate, because a little bit of your trading profit over here means a whole world to someone, half a world away who doesn't even make more than $1 a day.
Yeah, no, I respect that, man. Good on you. That's really impressive. Well, let's close this out. Kory, is there anything else you'd like to add? I mean, what if someone wants to find out a bit more about you? Are you on Twitter? I know you mentioned a website before. Where's the best place to go?
Yeah, so if anyone wants to contact me directly, they can email me. My email is hoang.kory@gmail.com. So that's my personal email. You can also reach me at info@quantprofit.com. Okay.
And I'll also mention you are fairly active in the Chat with Traders Facebook group. I mean, that's how I came across you. I mean, I wouldn't know about you otherwise. So I'll just mention you hanging out in there as well. If anyone wants to join the Chat with Traders Facebook group, it's chatwithtraders.com/Facebook. That'll redirect you directly to the group on Facebook. You've just got to request to join there, and of course, I'll accept you in. Kory, I appreciate you taking the time to do this. Thanks so very much.
You're welcome, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.